So I'll probably ruffle a few feathers by saying this. There's a type of investor I've been watching for years. In fact, I really admire their emotional resilience. They don't talk about markets much. They don't check their phones constantly every time the news changes. And when portfolios drop 20%, they don't look surprised. They look unbothered. Now, most people assume that's confidence or experience or some other kind of inside knowledge. And I'm sorry to say this, but I'm not referring to investors under 35. You see, the investors I'm talking about, they don't know what the market will do next any more than you do. What they have isn't better information. It's a different relationship with uncertainty altogether. And once you understand what actually changed for them, you start to see why investors in their 40s and 50s have a structural advantage most younger people don't notice. Stay with me, because by the end of this video, you'll understand exactly what the advantage is and how to start using it right now. I'm Neil. This is The Long View, calm, long-term thinking about retirement and investing for people who are done with the noise. If that's why you're here, please subscribe. New videos every week. Okay, so here's what we're covering today. First, why experience alone doesn't make investors calmer. Second, the hidden behavior pattern that separates reactive investors from steady ones. And third, the structural advantage that investors in their 40s and 50s quietly build without even realizing it. Okay, let's talk about it. Many people believe that calmer investors simply know more. They spend more years in the markets. They've experienced more crashes and survived. They were able to process data over 20 or 30 years. And yeah, experience does matter. But knowledge alone doesn't explain the difference, because there are plenty of investors who've been in the markets for 30 or 40 years and still panic every time prices fall. So experience isn't the answer. Here's what I think is actually happening. There's a habit most investors carry into the markets without even realizing it. And it shows up somewhere completely unrelated to investing. It shows up in conversations. Think about someone you know who interrupts constantly. Not because they're rude. They'd probably describe themselves as informed, engaged, quick, sharp. But watch what actually happens. Okay, so someone starts a story, gets halfway through, and before they finish the sentence, the interrupter jumps in, finishes the thought for them, corrects a detail, redirects the whole conversation. And most people who do this, they generally don't notice. And to be honest, it's rather annoying, because to them, it feels like participation. But here's the dilemma. What reads as enthusiasm at 25 starts to look more like impatience at 45. And mature people eventually notice something that younger people rarely do. Interrupting isn't a sign of intelligence. It's usually a sign of restlessness, the need to resolve uncertainty before it has time to resolve itself. Now, here's what most people don't realize about this. Most investors do exactly the same thing. As you know, the market moves in cycles. Long, slow, incomplete sentences. A downturn begins, and before the cycle finishes, many investors have already decided what comes next. They've written the ending in their heads. They react. They sell because the story feels bad. They buy again because it feels safe again. And to be honest, a lot of it comes from the media and what they want you to believe about the market. Then investors interrupt the market before it's finished speaking. And the data on this is pretty hard to ignore. Research from DALBAR, one of the most cited sources in behavioral finance, shows that the average investor underperforms the market by roughly 3 to 4% every year. Not because of bad investments, because of bad timing, reacting emotionally, moving too early, interrupting the sentence. And 3 to 4% annually sounds modest, but compounded over 20 years, it's the difference between a comfortable retirement and a stressful one. So what actually changes this? Something shifts when investors move into their 40s. It's subtle. Most people don't notice it's happening, but it's real. In fact, I remember noticing it myself. You stop trying to prove something. When you're younger, investing feels like a contest. Pick the right stock, calls, puts. You try to show others that you can beat the market, then brag about it online to prove a point. But at some point, many investors hit a wall. I know I did. Because the market is completely indifferent to your opinion. Nobody cares about your gains or your losses. The market rewards something much quieter, consistency. And the moment you internalize that, your behavior changes. You stop building a portfolio to impress anyone. You start building a system designed to outlast your emotions. So here's a question worth asking yourself. When markets fell sharply in 2020, what did you actually do? Did you have a protocol? Did you find yourself refreshing your portfolio, watching financial news, waiting for somebody to tell you what to do, whether to hold or to sell? Because without a predefined system, every decline becomes a new decision. And making a new decision under emotional pressure is where portfolios get destroyed. Not by the crash itself, but by the response to it. The goal of a good system isn't to beat the market. It's to make the market irrelevant to their daily emotional stress. Let me show you what that looks like practically. I keep roughly 6 months of my living expenses in cash. Because when I know my short-term needs are covered, my brain stops treating every portfolio movement like a threat. And that psychological shift is worth more than any return that cash might otherwise generate. I stopped trying to identify which business would win. I simply own thousands of global productive companies for the long term in one fund. And I keep roughly 15% in short-term treasury bills. Not because I'm bearish, because when markets fall sharply, I already have deployment capital. I don't need to find courage in the moment. The system already decided. Good till cancel limit orders sit at -5%, -10%, and -15%. When prices fall to those levels, orders execute automatically. No second guessing, no financial news required. And when you think about it, this actually matters. Because the worst investing decisions don't happen in bull markets. They happen at 2 in the morning, when you're anxious and the markets are closed and you're already rehearsing what you'll do when the market opens. If you have a system, it eliminates that entirely. But here's what surprises most people when they finally build something like this. The primary benefit isn't financial, it's attentional. Because once the system is doing its work, you stop chasing every headline. You stop mentally checking your portfolio while someone's talking to you. I know this well because it used to drive my mom crazy when I checked my stocks at the dinner table. You stop treating every piece of market news as information you need to act on. And gradually something changes. Your attention returns to the rest of your life. Conversations, relationships, ideas, books that you haven't read. The things that actually matter at this stage. And ironically, this calmer relationship with the market tends to produce better long-term results. Because staying invested for decades doesn't require brilliance. It requires emotional stability. And emotional stability is something you build deliberately, not something that just arrives with age. The longer I watch experienced investors, the more clearly I see a pattern. The calmest ones aren't the most analytical. They're not faster, they're not better informed. They simply stop treating the market as a contest. They build portfolios designed to remain steady under uncertainty. And they made peace with something that most investors resist. You don't need the answer to every question that the market asks. You don't need to form an opinion on every single headline. And you definitely don't need to interrupt a good plan. The market is still in mid-sentence, and the most powerful thing you can do is wait for it to finish. Marcus Aurelius wrote something that has stayed with me. Never esteem anything of advantage to you that would make you break your word or lose your self-respect. Most investors break something every time they react emotionally, not their portfolios, their system, their commitment to the long-term plan they made when things were calm. And what mature investors slowly figure out is that protecting the system is the same as protecting the outcome. The advantage investors in their 40s have isn't a secret strategy. It isn't access to better data. It's the accumulated wisdom to know what not to react to. And that wisdom, once you build it into an actual system, is compounding quietly every single day. If you're in your 40s or your 50s, and you're not sure whether your current approach actually supports a calm long-term plan, I built something called the Long-Term Retirement Checkup. It's a simple framework to help you evaluate your position clearly and honestly. No sales pitch, no pressure. Just a clear look at where you actually stand right now. Link is in the description. And if this kind of thinking is what you're looking for, subscribe. New videos every week. I'll see you next time. That's the long view.